All right, today we're going to do a little financial health checkup, and we're using one of the most fundamental tools out there for any investor, the current ratio. Now, it looks like just a simple number, but trust me, as we're about to see, it can hide a really fascinating story.
Okay, so to kick things off, let's start with a bit of a mystery. We've got two companies here. Let's call them Company A and Company B. Now, if you just look at one key metric, these two companies look, well, identical. But the real question, the one we need to dig into, is this. Are they really on the same financial footing? So take a look. See that number? 1.00. Both companies have the exact same current ratio. On the surface, it's a perfect tie, right? But this is where our investigation really begins.
So, to solve this puzzle, every good detective needs their tools. And our main tool here, the current ratio. So let's break down exactly what this thing is.
At its core, the current ratio is all about short-term survival. It's asking a really simple but crucial question. Can a company pay all its bills that are coming due in the next year, using only the stuff it can turn into cash within that same year? It's a real can you weather the storm kind of metric.
And the way it figures that out is by comparing two big buckets of stuff. So on one side, you've got your current assets. Things like actual cash in the bank, the money your customers still owe you, that's accounts receivable, and all the inventory sitting on the shelves. Then, on the other side, you have your current liabilities. This is all the stuff you owe, like bills to your suppliers, employee wages you have to pay, and any short-term loans.
And the math? Honestly, it could not be simpler. You just take all those current assets and divide them by all those current liabilities, and boom, that's your ratio. Simple, right? But don't let that fool you. Its real power comes out when we start to dig just a little bit deeper.
Okay, so let's get back to our case. It's time for our first major clue, and it's a big one. A single ratio is just a snapshot, a single photo. The real story, that's a movie. It unfolds when we look at the trend over time.
All right, now this is where it gets really interesting. We're looking at the history for both companies. Yeah, they both ended up at 100 today, but just look at the journey they took to get here over the last 6 years. You starting to see the pattern?
Check it out. Company A, it's showing a slow, steady improvement. It's a positive, stable trend. But Company B, it's all over the place. Its ratio has been generally declining, and it's way more volatile. All of a sudden, that 1.00 doesn't look the same for both of them, does it? Company A is on a clear upward path, while Company B, well, it's trending in a pretty worrying direction.
But wait, the story does not end there. The trend is a huge clue, for sure. But now we need to look at the quality of the assets themselves. It's time to pop the hood and see what the engine is actually made of.
Okay, so let's reset for a second. Let's imagine a new scenario. We've got two different companies, but same situation. Both have an identical current ratio. But this time, we're going to look at the composition of their assets. What are they actually made of?
So here's our new company A. You see that? That huge slice of the pie is inventory. Now, yeah, inventory is an asset, but it can be super hard to turn into cash quickly. I mean, what if nobody wants to buy it? What if it's a bunch of last year's models? It could be totally overstocked, or worse, obsolete. Okay, now switch over to Company B. See the difference? Way less inventory and a whole lot more cash and accounts receivable. That's money that's basically guaranteed to come in from customers. And cash, well, cash is king, right? It's the most liquid asset you can possibly have. So even though their current ratios are identical, Company B is in a much, much safer short-term position. It's way more liquid.
Okay, so I think we've pretty much cracked our case. Now, let's turn this into some practical ground rules you can use for your own financial investigations. First up, rule number 1. Think of the number 1.00 as your break-even point. It literally means a company has exactly $1 of current assets for every $1 of current liabilities it has to pay. So, from that break-even point, you can start to interpret the score. Anything below 1.00, that can be a red flag. It might mean the company could really struggle to pay its upcoming bills. A ratio above 1.00 suggests they're in the clear. They can cover their short-term debts. But, and this is a big but, you have to be careful. A super high ratio, like, say, above 3.00, isn't always a good thing. It could mean the company is just hoarding cash and not putting its assets to work to actually grow the business.
And this might be the most important rule of all. Context is everything. What's considered a healthy ratio for a software company is going to be completely different from a giant retailer that's loaded with inventory. You always have to compare a company against its own history and against other companies in the very same industry.
Yeah, this quote just sums it up perfectly. A single number, by itself, tells you almost nothing. The real power, the real insight, comes from comparison. You have to compare it over time, against its competitors, and against the industry benchmarks. All right, so after all of our detective work, what's the final verdict here? What are the big takeaways we've learned about the current ratio?
It really boils down to three key things. First, remember that a single ratio is just a clue. It's the start of your investigation, not the end of it. Second, the trend over time tells a much, much deeper story than any single snapshot ever could. And finally, the quality of the assets, how easily they can be turned back into cold, hard cash, that's what truly matters in the end.
So look, the current ratio gives us a fantastic look at a company's ability to survive the next year. But thinking about it also leads us to a much bigger question, doesn't it? If this ratio is a snapshot of the present, how in the world do you predict the future? Now that is a mystery for another day. Thanks for joining the investigation.